Good afternoon, everyone, and thank you for joining today's webinar on retirement planning for dentists amidst COVID-19, presented by Altfest Personal Wealth Management. My name is Jesse Frailing, and I am the Director of Retirement Plan Services here at Altfest, and I will be your moderator for today's webinar. First and foremost, on behalf of our entire team, we want to wish continued health and safety for you and your families. In addition, if you are a dentist who is either working tirelessly to reopen your practice or thinking about selling your practice or retiring early, we wanted to remind you that our team at Altfest Personal Wealth Management is here for you to answer any questions that you may have and help in any way that we can. So please don't hesitate to reach out to us if you may need anything at all. As always, we would like to especially recognize the New York State Dental Association and its district societies whose leadership and members are in attendance for today's webinar. As the preferred wealth manager for New York State Dental Association members, we are incredibly thankful to work with many of your colleagues as clients of our firm and to continue to have the opportunity to provide a range of benefits as well as timely content and education specific to the needs of dentists. If you're not familiar with Altfest Personal Wealth Management, we were founded as a fee-only financial planning firm in 1983, and we currently manage about $1.3 billion in assets on behalf of our clients. As a fiduciary, it is our mission to always put the best interests of our clients first. We offer truly comprehensive financial planning and investment management, and we specialize in providing services tailored to dentists throughout their careers and, of course, into retirement. Now I'd like to introduce today's speakers, Mike Prendergast and Jimmy Bassett. Both Mike and Jimmy serve as members of our advisory team here at Altfest Personal Wealth Management. Mike is one of our firm's directors and is also an advisor, and Jimmy is a senior advisor here at the firm. Both Mike and Jimmy spend a great deal of time working one-on-one with clients of our firm who are dentists. Today's topics of conversation will be risks in retirement planning and how to manage them, timely retirement planning opportunities, and how to evaluate where your retirement plan stands today. We will finish up with a Q&A at the end of the presentation. If you have questions during the webinar, please feel free to type them into the chat box on the right-hand side of your screen. We will do our best to answer all questions live. However, if we don't get to your question, we will certainly follow up with you via email or phone call. With that, I will turn the presentation over to Mike Prendergast to get us started. Mike?
Thank you very much, Jesse. And thank you, everyone, for coming to attend today's webinar. We know you're extremely busy, and we greatly appreciate it. As Jesse said, my name is Mike Prendergast. I am a director of the firm, as well as the director of the Altfest Dental Practice Group. I've been working with dentists for many years, and I really appreciate the work that you people do, and especially in terms of this time of crisis, my hat's really off to you. So let's make this time productive and dive right into the topics. So the first thing I'm going to be talking about are retirement risks in retirement planning, and how best to address them. So planning for retirement is the #1 financial concern of mid and late career dentists. And that really is no surprise, because retirement planning, or planning for retirement, is the #1 financial concern of people in general across the United States. People are wondering, how much do I need to save for retirement? What do I need to do to ensure a nice retirement after working so hard for so long? Next slide, please. But it's interesting, because even though this is the #1 financial concern on people's minds, very few people actually know where they stand regarding their retirement. Are they on track or not? And how to successfully get to a happy retirement from this point forward. Now, dentists frequently ask us many questions. One of the most frequently asked questions is, how much money, Mike, do I need to save for retirement? Unfortunately, with many financial questions, the answer is, it depends, and is different for each person. But why is this? And why is this big question so difficult to answer? Well, the reason is because there are certain factors that are very important where we often don't have the best grasp on. For example, we do not know how long we will live. In the financial planning community, this is called longevity risk. We also don't know how our investments will perform over time, investment risk. And we don't really know, as lay people, what the effects of inflation will be on our assets over time, also known as inflation or purchasing power risk. But if we can make estimates in these three areas, we can determine with a high degree of probability whether one will be able to set oneself up for a good retirement or not. So let's talk about these three risk factors one by one. The first one is longevity risk. Now, I personally really like this slide because I work in the industry and it gets me going. But it may be a little bit busy and you can look at it over time. But the big takeaway from this slide is that people are living longer in retirement than ever before. According to this research, you can see where it's 95 years, there's a 14% chance of a woman living to 95, a 7% chance of a man living to 95. Now, the research that we use shows that for people who are 65, men and women in your cohort, affluent, educated, have good access to healthcare, there's a 10% chance that you will be living into your late 90s. Now think about that. That means that you could be living, once you were, assuming you retire at age 65, you could be living 30 or more years in retirement, and we need to plan for that. Next slide, please. Inflation risk. Now this is a risk that people don't think about when they're planning for retirement. It's kind of like a thief in the night, and it's little by little stealing something from you if your investment portfolio is not prepared to take care of that and mitigate that factor. What is it stealing over time? It's stealing your purchasing power, and meaning that the prices of assets are going up, and you need to make sure that your portfolio grows at least by that amount after taxes in order to maintain, if not better, your standard of living. So let's look at some examples. In 1976, about 44 years ago, a new home, the average median price of a new home in the United States was $48,000. Now, homes vary from place to place, so let's look at some examples we can all relate to. A first-class stamp in 1976 cost 13 cents. Now it's in the low 40s, 41, 42 cents. It's more than tripled in price. The New York City subway fare, 1976, it was 50 cents. Now it's $2.75. It's more than quintupled in price. A movie ticket, $2.13. I can't speak for every region of the country, but I know that in Manhattan, for an adult, it's $15, $18. So purchasing power can be eroded via inflation, and we need to prepare for that. Next slide, please. Now, investment risk is the risk that everyone thinks about, and that's because they see it every day. They see it in the news, they see it on the television. This is the risk that your investments will not grow at the level that you expect. The good thing is that in our planning for our clients, which we've been doing for over 30 years, we make investment return assumptions for the retirement planning portfolio that are based on long-term historical data overlaid by Altfest's proprietary economic and market outlook. And so since there's a chance that you may be living for 30 or more years in retirement after 65, the likelihood that the the investment portfolios that we manage for our clients before and after retirement, meeting the retirement projections that we make in our retirement planning, the likelihood that we match them or better them is very good. Next slide, please. There's another risk in retirement that's specific to dentists, and this is the value of the practice risk. This is the risk that a practice is not worth what one thinks it is. Next slide, please. So many dentists don't have a good idea of what their practice is worth. They may have a general idea because they know a few rules of thumb, or they have some knowledge of a few dental practices that have sold in the general area, but rules of thumb and anecdotal pricing can be way, way off. And so if one doesn't know what the dental practice is really worth, it makes it very hard to do quality retirement planning and know what you need to do to go from point A here to a happy retirement in the future. Because if the inputs are kind of squishy or vague or not that accurate, the analysis and recommendations are going to be squishy and vague and not that accurate. So what are some ways to manage these retirement planning risks? We at Altfest recommend that when doing planning, that you fund a retirement that has you living into your late 90s. Now, like we said, you could die earlier, but 10% of people in your affluent cohort will be living into the late 90s, and we need to plan for that and make sure that funds are available for a long and happy retirement. We also want to account for inflation's effects in your plan. For example, we use in our planning on average about 2.25% for general inflation, fluctuating from year to year based on the retirement planning software's myriad of calculations. And we use 3.5% for medical inflation on average, again, fluctuating from year to year with each scenario that the plan does. You also want to choose an investment portfolio that targets a good amount of equities, even during retirement, because you want to make sure that your portfolio has the ability to grow significantly over time to be able to fund a long and happy retirement and overcome the purchasing power reduction effects of inflation. And lastly, you want to get an independent, objective valuation of your practice so that you can know exactly what your practice is worth and be able to do quality retirement planning from here on out. Another benefit of getting an independent objective valuation is that if you're not satisfied with what the practice is worth, you still have at least several years of retirement runway to work on your practice in order to get it the numbers in shape so that it can realize the value or as close to the value that you want to get when in fact it's time to sell. Also, if though you find through your retirement planning that doing what you're doing, doing what you're currently doing and just keeping on doing it does not create a high probability of retirement success or retirement planning success, there are some ways to make some trade-offs that are the ones least painful to you in order to put more financial strength into your plan and to get as much as possible of what you want in your happy retirement. For example, you can delay your retirement by working longer either on a part-time or full-time basis. Many of our dentist clients elect to do this. Maybe they were working 5 or 4 days a week and they move it down to 4 or 3 days a week. That can be very helpful in terms of financial planning strength. Also, you can reduce your annual living expenses, and that when you're working, that also means increasing your annual savings rate, or in retirement, of course, just maintaining the reduction in your annual savings rate. And just a little reduction in living expenses can have a very big and positive impact over time because the positive benefits of taking less out of your portfolio get magnified as the decades go on in terms of planning. Another thing that people often do is they decide to sell their practice. They decide to sell their home sometime in retirement in order to unlock the equity in order to fund the later stages of a long retirement. And the last thing is some people who have the interest consider moving to a lower cost state in order to have high quality of life at a more reasonable price at lower expense level. Next slide, please. So now I'm going to talk about some timely retirement planning opportunities. Let's go into the first one. The first one I'm going to briefly talk about is Roth conversions. So what is a Roth conversion? Very briefly, we know that it's when you move assets or convert assets from a traditional IRA into a Roth IRA. In the year that the conversion happens, income tax is going to be realized on the amount that was transferred into the Roth IRA, and it's going to be taxed at ordinary income tax rates. Next slide, please. Now, why would this be a good idea? There are several potential benefits. One, It really works when you can pay taxes at a lower rate now, lower ordinary income tax rates, and avoid paying taxes at a higher rate sometime in the future. Also, it's very important to know that Roth assets, the investments in the Roth, grow tax-free until they're withdrawn. Also, there are no forced distributions later in life for the Roth IRA owner or if they transfer it upon their death to their spouse, which is great. And for beneficiaries beyond the surviving spouse, there's no income tax burden for people who inherit a Roth IRA. This year, 2020, could be especially advantageous because this could be, for some people, a lower income year due to lower compensation. For example, as we know, Governor Cuomo and the state governors were restricting and closing dental practices during the coronavirus crisis. Recently came out in June, but that could cause a slowdown in income for the year. Also, for some of our older dentists, usually they would have to take a required minimum distribution from their IRAs. This year that's been waived, and that would mean less income and less tax on that income. Another thing to think about is future tax rates. There is a chance that future tax rates could go up. Why is this? Because the country, in order to combat the devastating economic effects of coronavirus, has been spending a lot of money and has been borrowing. $3 trillion already has been borrowed on the fiscal side. Congress is now negotiating amongst itself to determine how much more fiscal spending should be put into the economy. Republicans say $1 trillion, Democrats say $3 trillion, maybe it's going to meet in the middle. All this borrowed money has to be paid back sometime. One of the ways it could be paid back is by increasing the tax rates on higher income earners and more affluent people like yourselves. Another thing which may be a factor in the Roth conversion is if asset prices are temporarily depressed. Things have really risen up on the equity side since the depth of the coronavirus-induced reduction in the markets, which was at its nadir in about the middle of April. Now we're close to where we were before coronavirus, but there's still going to be a great deal of volatility this year. And so if you think it makes sense to do Roth conversion and the markets are temporarily down, that's a great time to transfer some assets into the Roth, and then those assets can grow back over time, and all that growth over time will be growing tax-free within the Roth IRA wrapper. Now, there are some considerations because a Roth IRA is not for everyone. Everyone's situation is specific to them, and there are pros and cons, so we'd have to do an analysis in order to see whether it would make sense for you. Before you convert, some things to consider. One, it's very important to be able to pay the taxes that are due on the assets that were converted into the Roth out of taxable funds, meaning a checking account, a savings account, a taxable brokerage account. You don't want to pay the taxes that is due on the Roth IRA conversion from funds that are coming out of the traditional IRA. You want all of those funds to go into the Roth so that as many funds as possible can grow and compound tax-free over as long a period of time as possible. Also, if you think that you're going to be in a lower tax bracket in the future, either because you're in a very high tax bracket right now, or because maybe in the future you plan to move out of state to a lower income tax state, perhaps maybe Florida, it might not make as much sense to do a Roth conversion. Another thing is that if you're very charitably inclined and you've earmarked a lot or all of your traditional IRAs to go to charity, that is a factor that would reduce the likelihood of it being a good idea to do a partial Roth conversion. The bottom line for Roth conversions is that there are potential benefits down the road for many people, but it's not for everyone, and there are many factors to consider. So consult with a professional who does this a great deal of the time, like ourselves. Now we're going to go on to another topic. And this is, again, what we hear, because we're talking to dentists all the time, and we're often hearing the same thing. Usually people are unhappy and complaining that they're getting hit with very high tax rates. We know that state and local taxes and property tax deductions are now capped in the Northeast. We might not have saved, many people are concerned that they've not saved enough yet for retirement, no matter what age they are. and they want to turbocharge their retirement savings. So what can we do? A potential solution is a workplace retirement plan. So this is an opportunity for you as the practice owner to be able to tax defer, put more money into tax deferred accounts than employees of other companies, because you get to choose the plan. You can choose a workplace retirement plan that best fits your situation now, and then you can change it over time as your circumstances and needs change. So let's talk about some of the benefits on an overview level. Benefits for the practice. It definitely helps recruit and retain quality employees. It helps reduce employee stress and enables them to be highly engaged and really focused on giving the quality patient care that you're known for by helping them plan and prepare for retirement. They know that you care about them and you've instituted a vehicle so that they can plan for their family's retirement, and that can let them focus on the patients, which is a great thing. Also, just to remember, a practice receives a tax deduction for funds it contributes to a plan on the employee's behalf. So there are also, of course, very significant benefits for the owner and the employees. Not least is that it reduces this year's tax bill. All that money would be going in on a pre-tax basis. And this enables the funds in the account, the investments in the account, to be growing tax deferred over time and growing tax deferred, and it enables the investments to grow faster than if it were in a normal brokerage account, because it's avoiding a second tax, which I'll talk about in the next slide. Also, to remember, if your tax bracket is expected to be lower in retirement, workplace retirement plans could provide even more benefit. So let's look at an example. Here we have two dentists, Laura and Lenny. Both of them are thinking about investing about $55,000. Laura wants to do it in a 401k. Lenny wants to do it in a taxable brokerage account because he doesn't really see the benefit of the 401k. How do they both, play out? With Laura, she has $55,000. All of that goes in pre-tax into her 401k. No taxes due now. The whole $55,000 gets invested. Now, assuming that $55,000 grows 10% a year for 30 years, that's going to grow to about $950,000 in 30 years. And then assuming that the marginal ordinary income tax bracket for Laura, both now and in retirement, is 40%, state, federal, subtract about $383,000. And so she's netting about $575,000 in this overview example. What's going to happen with Lenny? Lenny, like we said, investing in a taxable account. So he wants to invest $55,000, but he really can't because he needs to pay the taxes on that $55,000 before he can even start go. So $22,000 or 40% is taken right off the top, and then it's going to grow. That $33,000 will grow 10% a year for 30 years, and it will achieve $575,000. You can see that that's the exact same number that Laura nets, but unfortunately for Lenny, he's not at the net stage. He's still one step before that. Why is that? Because he's growing the funds in a taxable account. He needs to pay taxes on the growth along the way, whether that's income tax, whether that's ordinary income tax on investment income, qualified and non-qualified dividends, capital gains distributions, or capital gains taxes that he realizes upon a sale. To make the example simple, we assume 20% for state and federal on the capital gains side. Now his amount that he realizes is actually $460,000, the difference of that second tax. Like we said, if tax rates are lower in retirement, then Laura's still going to keep $575,000. Actually, Laura is going to have more than $575,000 because let's say it's 40% tax bracket now, maybe 30% in retirement for her. She's going to pay 30%. She's going to have more than $575,000. Whereas Lenny, unfortunately, he paid the 40% up front. He doesn't get the benefit of paying the 30% later instead. Next slide, please. So in conclusion, with workplace retirement plans, in terms of potential next steps, one, it's very important to consider the practice's cash flow, the amount of cash flow, and the stability of cash flow per year, as well as your annual personal savings ability. You want to work with a dentist-focused wealth management firm to determine the best option for you, because there are several different types of workplace retirement plans, and each has pros and cons. And then, of course, you want to implement it in order to reduce your current taxes, increase tax-deferred growth, and achieve financial independence faster to get to that nice retirement as soon as you can. And now I'm going to be turning over the presentation to my good colleague, Jimmy Bassett, who's going to tell you about how to evaluate where your retirement planning stands today. Take it away, Jimmy.
Thank you, Mike. I'm Jimmy Bassett. I'm a senior member or a senior advisor at Altfest. And like Mike, I work with a number of dental clients at the firm. I'm a member of our financial planning committee and also a member of our investment team. Now, what I would like to do is come back to one of the main questions that we had today that I'm sure a number of you have, which is, how do I know if I'm on track to retire? Or to put another way, or how we might look at it, is how do we determine a successful plan? And for a plan to be a success, we really would like to say that we are confident that you will be able to maintain the lifestyle you want for the rest of your life. Now, to dig into the roots of that statement, let's look at the core elements we use to evaluate a retirement plan. There's three main elements, and that's your inflows, and that's what you use to maintain or fund your retirement. Typically, that comes through income like Social Security, pensions, possibly annuities. The other big driver is obviously investment earnings. So that's going to be based on your starting assets and determined by the rate of return that you're getting from your asset allocation. Next item we're going to look at is outflows. So this translates to what the lifestyle you have that you want to maintain, which underlying it mainly comes from your expenses, whether that's general living expenses, housing, medical expenses, potentially expenses for children. And as Mike had mentioned before, inflation really comes into play here. It's a huge factor. It's something that we are very cognizant of when we're looking through plans. We also look at taxes. This can be a hard thing to look at. We use some very sophisticated software in our analysis. We'll talk about that a little bit in just a bit. But the third element I want to focus on is time period. Now, as Mike had shown in his slide before, for individuals your age, especially those that are more affluent, living in places where there's good quality medical care, your life expectancy can be pretty long. So using an appropriate number for that is very key to getting a good analysis put together, and then also deciding when you retire. That gives us our time period. Now, these are the guideposts that help us determine where someone currently stands on their roadmap. And as I'm going to go over next, you're going to look at a little bit of the approach that we use for our clients to move along through that process. So these are the core steps that we take that we think by going through really helps us be confident of being able to maintain that lifestyle. So first and foremost, we want to understand our client situation. So for a lot of dentists, that means where they stand now with their practice, whether there's a planned sale coming down the line or whether there's another transition to maybe manage. For a lot of dentists, it can be potentially moving to a new place, handing off a practice to a successor, and then kind of resituating where the expenses are going to be in retirement. And to that end, we want to capture all the pieces. So again, there's a lot of expenses that pop up in retirement that you may not be used to right now, whether that's medical expenses, planning for taking care of properties in the future when you don't have an income. There's a lot of different elements that come into place. We want to make sure that we capture all of it. The next item that we look through is making sure that there's accurate investment expectations. So as investment managers, we're keenly tied into how we help clients manage that. And then lastly, again, for confidence, we want to account for the unknown. So the next slide is a piece from one of our planning reports that shows the level of detail that we like to have when putting together a full plan for a client. So as you can see, we're moving through year to year. We're progressing on the timeline. And at the top, you'll see the inflows that come in. So these, again, are going to be the pieces that are driving how you fund your retirement. So you can see we break down the different categories of where your investments stand, whether they're already in taxable brokerage accounts, whether they might be retirement accounts, where there's going to be bigger tax implications later down the line, and also what cash is available to handle immediate funding. And then along with that, cash inflows, so any salary that's currently being earned and potentially used to save, Social Security that's going to come in, and then any other income flows. And some of those are going to be ones that are starting and stopping, other ones that might be picking up later. For instance, if you're going to be scaling back to doing part-time work, that's something we're going to want to account for and make sure that we capture. And then the other element, big one, that's usually a little bit harder to get your hands around, are the outflows. So again, these are expenses. It's going to be living expenses. It's going to be liabilities like mortgages. We also, as I mentioned before, factor in taxes, which can really fluctuate year to year depending on stages of retirement, income that you have, and then all sorts of other expenses. So you can see these categories here where we really do want to capture everything. And I know what kind of hard situation this can be. Traditionally, this is one of the more difficult areas that we work with in our clients to try and get an idea so we can really wrap our hands around. And when we're going through it, we don't need to be as detailed as trying to figure out how many times you go to Chipotle in a year. But we do want to make sure that we have an accurate picture to project for when expenses are going to be starting and stopping and what levels they may be growing at. For instance, items like medical expenses, we project to grow at much higher rates than traditional living expenses. Now, because we know this is so hard to get around and can be a stumbling block for certain clients, we do have technology to help us. So what you're seeing here is actually an excerpt from one of our softwares that we utilize through our client site. And what we are able to do is pull in individual transactions by linking credit cards or checking accounts to get all the bits and pieces to come in. And they get automatically categorized, but they can be adjusted. As you can see here, new rules can be set up. And basically, as this comes through, we start getting the pieces together. And after a while, what you'll see on our next slide is that we get a full picture of what expenses look like as a breakdown over time periods. So this really provides us a good gut check and a real grounding in reality when we're trying to put our estimates together to form a bigger plan. And we found technology like this extremely helpful in being able to aid clients in that data accumulation process. So the next pillar that I wanted to discuss that I mentioned earlier is the investment portfolio. Again, this is going to be driving a large part of the growth. As you enter in a mode of retirement, you're typically going from adding to a portfolio to drawing down from it. And we know that understanding a portfolio and having it coordinate with a plan is key to success. So as investment managers, we like to make sure portfolios are aligned with goals and properly diversified. We use both historical numbers and our experience to be able to get realistic expectations for where investment returns are likely to be and where they can go going forward. Now, of course, just returns are not all of it. We also use our expertise and data to formulate risks and variability. And that's going to actually move on to our next part, where we're looking at what real life can be like. And again, this is where our confidence comes in. What you're seeing here is a chart that models out statistical analysis that we use in our software that's very sophisticated. You may have heard of an example of this before. It's called Monte Carlo analysis. And essentially, what this does is it runs thousands of trials based on your actual portfolio composition, how it's managed, including drawdowns that we figure out from input, income, and output of expenses to get an idea of where the portfolio is likely to go in the future. It's not relying on just a straight line number. We're able to see variation, and from that, gain a level of confidence. So what I'm going to do next is show you kind of a run through of what we put together, all the different elements to see what a retirement plan might look like. Now, again, we have all the inflows, incomes, expenses, and we're modeling out here the growth of investment assets through the whole expected time period. Now, you see it ends up pretty high. It ends up close to 6 million, which is great, and that can be instill a level of confidence. But this is actually the Monte Carlo analysis here, and you can see that the probability of success is only in the 70s, which is still better than half. But when we look at things, you want to see that a really high level of confidence. So what I have here is some plan changes that we had put through, where we adjust time of retirement, when to take Social Security, contributions to 401ks, and you can see the probability shoots up into the 90 percentile, which we really like. And when you go back into the portfolio to see the direction of how that helps it grow, we think this is a great way of being able to show clients just how much of an effect doing some small changes can make. Now, I'm actually going to move forward next and talk a little bit about the service that we had mentioned earlier about the retirement readiness analysis that we're offering to NYSDA members as a complimentary service. Now, again, this isn't as in-depth and rigorous, doesn't have the statistical testing that we do for our full clients, but it does go through the main core areas that I mentioned initially when you're looking at a retirement process. So we're coming up, as you can see, the retirement ages of when retirement's beginning and when it ends, or again, our expectations for full life expectancy. So we're getting our time period. We're also getting a living expense number. So that outflow number of where it's coming in, getting some estimates for taxes as well is key to understand. And then you can see all the elements for inputs as well and inflows. So the retirement assets or qualified assets here, other assets, other savings they may have, and then also sources of income outside of investments like Social Security or if there's a pension, something along those lines. So what we're able to do is, again, take those core element pieces and put them together in a big picture. So next you'll see with these elements, we're able to get a rough estimate of the cost of what a retirement might be, the sources of income and the value that would be in a retirement, and also expectations for what you're able to withdraw from a portfolio. So getting those elements and getting a big picture, we can see roughly based on those projections where a shortfall or surplus may be at that time. So we can get that both in a dollar figure number and also an idea of how long those assets would last and maybe the gap that would need to be made up. And one other element that we include with this are just a few little guide points. Mike had mentioned earlier, ways that you might be able to adjust to meet those deficiencies if they are there. So whether that's increasing your current level of savings, reducing expenses, or potentially delaying retirement by a certain number of years, these are all good jumping off points to explore the different levers you can use in seeing where you are and seeing where you could be. That includes kind of my rendition and summary of the retirement readiness and my portion of the presentation today. So I'm going to pass it back to Jesse as I believe we move on to our Q&A time period.
Excellent, and thank you, Jimmy, and thank you, Mike, for that great information. Thank you both again. And sort of to Jimmy's point, as Jimmy highlighted, this retirement readiness benefit is something that we're tremendously excited to offer here at Altfest to NYSDA members, and we certainly encourage you all to reach out to us to take advantage of this benefit. As Jimmy mentioned, it provides a very nice jumping off point, a good snapshot of where you stand currently versus what your retirement goals are, and we can certainly help you then gauge where the next steps might be in terms of a deeper analysis once we conduct that retirement readiness snapshot for you. And as Jimmy also mentioned, it's certainly not an exhaustive analysis, and Altfest takes a very comprehensive approach to wealth management. So we're helping our dentist clients and all of our clients, quite frankly, examine opportunities to reduce their taxes, to reevaluate their insurance needs as their careers go on and they consider retirement. And an often overlooked area is certainly being updating their estate plan and assessing those estate planning considerations as they move into retirement, certainly as well. And Max, you can go ahead and launch, I think, the poll that we have. We have a poll question upcoming for all attendees on the line. Feel free to launch that now. The poll, I'm being notified, has just been opened, so that's terrific. So I'll give everyone about 15 to 30 seconds here to answer that poll. Well, once again, you can see my contact information on the screen. You can see my phone number, my direct line, 212-796-8732, and you can see my email address there. Please feel free to reach out to me if you're interested in this retirement readiness benefit. We'd be happy to conduct one for you. And with that, I think the poll may still be open. There we go. I think that's been closed. Perfect. And so now I want to move on to the Q&A portion of the webinar. And I do have some questions that have come in through the chat box. So thank you again for submitting those. The first question being, I heard recently that the required minimum distribution rules have changed for people who have an inherited IRA. Is this true, and does it apply to Roth IRAs? Mike, I think this might be a good question for you to tackle, if that sounds good.
Sure, thank you very much. Yes, that's a very good question. So the Secure Act, you might have heard the name of it. It's a big piece of legislation that happened towards the end of last year, early this year. And basically it changed the rules for required minimum distributions for people who inherit IRAs or 401ks after if someone has passed away after January 1st of 2020. So it used to be that people who inherited IRAs would be able to take required minimum distributions over their lifetime. Now, because of the new rules, again, if you inherit something after January 1st, you have to take required minimum distributions within 10 years of the time that the original account owner passed away. There are some exceptions. For example, the spouse of the original owner, maybe, of course, a minor child, someone who is disabled or who is chronically ill, and lastly, someone who is less than 10 years younger than the original account owner. But for the vast majority of people, once they now start inheriting an IRA, they will need to take out the assets within 10 years. And this is both for traditional IRAs and Roth IRAs.
Thank you very much, Mike, for clarifying that. And thank you as well for pointing out the exceptions, as well as, of course, the updated legislation as per the Secure Act. Thank you, Mike. The second question we have, there have been numerous lawsuits against retirement plan sponsors for fiduciary breach in recent years. What steps should we be taking to ensure that we are meeting our fiduciary responsibilities to our workplace retirement plan? That's a great question. Mike and Jimmy, if you don't mind, I might try to take a stab at this one, if that's okay. My name, once again, is Jesse Frailing. I'm the Director of Retirement Plan Services here at the firm. So that's a terrific question. And certainly there have been a wave of ERISA-related lawsuits related to workplace retirement plans, and fulfilling your fiduciary responsibilities. If you have a workplace retirement plan, as a plan sponsor, you are automatically a fiduciary of that plan. And there are certainly a lot of things that you need to know and make sure that you're taking care of as part of that responsibility. I would say as a high level, and I can certainly follow up with everyone individually here who has questions about this very important question, is document your process. You have to demonstrate as a fiduciary that you are documenting that you are acting in the best interest of your plan participants. And this it can relate to a number of issues, but I will just point out a couple that I think are particularly relevant when looking at this question. When you look at the lawsuits that exist in recent years and are ongoing today very much so, they relate to mainly two areas. One is fees, and two is investment selection and monitoring. So what really helps as a plan sponsor when I'm talking about being able to document and demonstrate your process for those two areas is having something that's called an investment policy statement. Now, that's something that is very commonly seen among defined benefit retirement plans, and also things like a foundation account or an endowment if it's a nonprofit organization. However, they are still, even to this day, with the amount of ERISA litigation that's taking place, much less commonly seen in defined contribution workplace retirement plans such as a 401k plan. So having an investment policy statement where you are laying out your process for monitoring those investments and how you're selecting those investments that go into your plan is very, very important. And you might be wondering, as a plan sponsor, why is that my responsibility? Well, that is the way that ERISA law that governs 401k plans and other qualified retirement plans is written. And unless you are utilizing an investment advisor that's serving as what's called a 338 fiduciary, once again, a 338 fiduciary, the responsibility to select and monitor your plan's investments is actually on the back of you as the plan sponsor. So I just wanted to clarify that. And then also being able to benchmark a process and document a process for assessing your retirement plan's fees that participants are paying each year is very, very important when you're talking about the steps that you should take to mitigate your fiduciary liability. And once again, it's a complicated question, but I hope that helped, and I'd be happy to discuss further on an individual basis. Move on to the next question here. I've heard of certain strategies for retirement planning, like the 4% rule. Are rules of thumb like this accurate? That's a great question as well. Jimmy, I'll direct that question to you if that sounds good.
Yeah, absolutely. This is a pretty common rule that's out there, and it's come around. It's been around for a number of years, and it's not bad for where it usually comes up, which is in general financial literature. Again, it's a rule of thumb. Where I find this and others, such as you need to have X times your salary by age 65, is that while it's good general guidance for general people, it really doesn't come into play with the specifics that we find with clients. Both, one in trying to prepare for, just the way life is. So again, 4%, you want to draw down 4% of your portfolio. So you have $1 million portfolio, you can take out $40,000 a year. All right, well, where do you take that from? What account is that coming from? What investments do you sell to get it? Is that before tax? Is that after tax? There's a lot of different details when the rubber meets the road of how that comes into play. Similarly, especially for dentists, when you're trying to calculate it based on a salary number, is that, your revenue, revenue after expenses or after tax? All of these items can be very intricate. And the one thing that they really all kind of fail to do is they help, or they don't help you plan. So they don't help you get to a place where you're necessarily going, or make an adjustment or evaluate, well, can I afford that vacation home, or what happens if I move out of state? What will that change? And that's where we find really digging in and finding the specifics, getting to know our clients and putting those details into a plan really add a benefit.
Certainly, Jamie, that's a terrific answer as well, and it certainly becomes more complicated depending on the classification of your investment assets, whether those are in qualified pre-tax accounts such as a 401k or an IRA, whether it's in a taxable brokerage account, whether some of those assets, as Mike was pointing out before, have converted to Roth, and that's certainly part of our process here at Altfest, is determining a withdrawal strategy in terms of the order of withdrawals, in terms of best tax location to take those assets as withdrawals once you are in retirement. So thank you, Jimmy. Another question we have is, do you help your clients model different scenarios for all critical financial decisions, even if they don't specifically relate to retirement? For instance, if I'm deciding whether to sell my house, whether to buy or rent, whether to purchase long-term care insurance, whatever the decision may be, do you advise clients on these issues, and does your software help in this process? I think that piggybacks nicely, Jimmy, with your demonstration earlier of some of our software. Do you want to take this one as well?
Absolutely. So as you can see, especially the slide I outlined that had the cash flow page, where we're looking at all the different elements. This is one of those areas that really builds on itself as we go and work with clients, because not only does it help plan for retirement and get good expectations for long out in the future, but it also lets us run different scenarios. During the walkthrough, you saw the retirement plan options. We can just, as likely put in together modeling out something like the sale of a home, or adopting a new long-term care policy. And what's great is, you can see within the graphic, it kind of change and see the difference on those green bars and the difference on that success rate. That's what we can help quantify and help really show, and even show things side by side to clients to see what's a better strategy that may net more money at the end of the day, or what's more likely to succeed. Because again, it's not always going to be just increasing the size of your portfolio, but it's being confident that the strategy is going to work at the end of the day.
So true, Jimmy. Well said. And I think it's very important that you, as the question was sort of suggesting, you pointed out that this, the types of scenarios that we're running may not have anything directly to do with retirement necessarily, at least not in the traditional sense. But we know that so many other areas impact a client's finances so severely that we want to be able to model those specific decisions that can be so critical as you do plan for retirement. So thank you for that answer. Next we have, I want to contribute more to my practice's 401k plan, but if I were to maximize my contributions up to the IRS limit, the plan would fail testing and I would get money back at the end of the year. That's a common problem. Is there a way to fix this so I can contribute more to my 401k? Mike, would you like to respond to this question? And I can certainly piggyback off that as well.
Sure. That is, as Jesse said, is a very common occurrence, but there's a solution. So if you find through your current workplace retirement plan that at the end of the year you're having to actually take out money, that you cannot only contribute so much, which is tied to testing rules determining, which is based on a percentage of how much are the highly compensated employees paying into the system versus the regular rank and file employees. If that's the case, you can change the type of 401k plan to what's called a safe harbor 401k plan. Now, of course, there's always a trade-off. So with this type of safe harbor 401k, you commit to contribute a certain amount of money into the plan on behalf of the employees. It's a fixed small percentage. But in return for that, you do not have to go through the testing rules. And so that's why it's called a safe harbor, because basically you're like a ship in a safe harbor and you're not going to be buffeted around from year to year based on the testing rules. You're kind of exempt from them because you've already paid some into the system for your employees. So there is a way around that, and it's very nice because then you can have stability and knowledge of, I can feel calm that I can contribute X amount every single year, and I'm not going to be subject to the vicissitudes of how much are my employees contributing and have that affect how much I personally can contribute. So that's a great question.
Definitely a great question, Mike, well said. And an additional, just one addition I would make to that response is that something that we see very commonly in terms of plan design, especially with dental practices, is something called new comparability testing. And it tends to work very well with dental practices because it's often the case we find that the owner of the practice, there's a significant age difference between the owner or owners of a practice and the non-highly compensated employees, the non-owner employees. And it tends to work very nicely in terms of allowing, if you're especially a dental practice owner that wants to catch up with your retirement contributions, new comparability testing can allow you to contribute a tremendous amount. Up to $63,500 is the total amount that you could receive, both in terms of your contributions and the employer contributions as well to an individual 401k account. And new comparability testing often works well for businesses such as dentists. So I just wanted to add that as well. Thank you again, Mike.
Good point.
Thank you. And I believe the last question I have here is, my portfolio is invested primarily in large cap US stocks, and it has done very well. Why would I want to diversify my portfolio into other asset classes that haven't performed as well as I near retirement? I think this is a great question. Jimmy, you had shown the asset allocation sort of breakdown chart. I can pull that up again as well. but both Jimmy, Mike, feel free to tackle this one. I'll bring up this slide. I think it's a good one for this question.
No, absolutely. I can start off by saying a quote that's pretty popular in our industry. Historical performance is no guarantee of future returns. Sorry, it's almost like an internal joke here. So yeah, if you've been following the stock market, especially the stock market that pops up on most CNBC charts, you see it's done really, really good over the past few years, and that's definitely led certain people to ask, well, what's the need for diversification? And the way that we look at all of this is that we really look back and a mixture of what history has taught us. So if you go back, more past than just the past decade, you'll see that there's lots of areas that put out different asset categories or sectors of the market that come in and out of favor. In fact, JP Morgan puts together a great chart every year that shows just how the performance shifts up and down between these areas. But even going beyond just trying to predict the future, one of the things that all of our clients have when they're entering a state of retirement is having a sense of comfort, having a sense of confidence that they're going to not just make it to the end, but they're going to be able to progress every year. And one of the ways that you can ensure that, while you're in a period of drawing down from your portfolio, that there's money there to do it, is to have a diversified portfolio. And this year is a great example. I mean, yes, right now, things have bounced back. We don't know what the future is going to hold. We could see another leg down. We don't know. But again, we had clients that in March, had to start getting plans together for tax payments or had living expenses that they needed to take. And if your only options are to go into your portfolio and pull from a big, large cap stock that may be down 20, 30, 40% at this point, you don't want your hand to be forced. You want to have some options to look at. So having some bonds in your portfolio are important there. And again, you can have a lot of different options, and it's important to not let things get stale and keep up with where the markets are going and what expectations look like, so you can get the best returns over the long term. But yeah, concentrating into just one area can really lead into trouble. And I'll let Mike take on anything that you might want to add there.
No, this is a great question. I mean, we could have an hour easily on this question alone because it really gets into a lot of different things. But the really thing right is what Jimmy was saying is that past performance is no guarantee of future returns. Just because something has done well in the past does not mean that it will do well in the future. In fact, there's a greater likelihood that it's not going to do as well, especially in the short-term future, because the prices have been bid up so much. So this is a very common thing that we see with a lot of our dentists and healthcare professionals, because you are experts in dentistry. You know things inside and out. We are experts in all areas of personal financial planning, not the least among them investments. And so we have a very good idea of what an investment is worth. And so when you see an investment, like let's say the large cap domestic stocks, if they've been going up year over year over year, the big question you have to ask yourself is, what are these things really worth? And is the current price reflecting what they're worth right now? So actually, this is a nice segue into what we've been doing for some of our clients, because in the beginning of last year, beginning of 2019, we started to get very concerned that the prices for certain assets, including large cap US stocks, were getting too expensive, that people were paying too much for every dollar of earnings. And we didn't think that it was sustainable, because eventually people will figure out what the product is really worth. And then if they've overpaid, they will start selling it down in order to get it to its real price. So what we started doing is, always a year ago, we didn't want to run the risk in our clients' portfolios because we're a little bit more prudent and conservative. We wanted to protect our people's money. So what we started to do is reduce the amount of a little bit of large cap stocks, or go into more defensive US stocks. We also went into some hedged equity products, which would reduce the amount of downside that our clients would have to experience, some downside protection, of course, with the trade-off of capping on the upside, because we were concerned of a trigger event that could cause markets to go down. Now, we're not saying that we have a crystal ball. We didn't think about the coronavirus, but we were thinking that prices are very high for existing stocks. And we think that there could be a recession. There could be, a lack of earnings being generated by the company, something that would trigger people to lose confidence and start selling. So because of that, when coronavirus came, we were actually prepared. We didn't know about the trigger event of coronavirus. We were thinking more of a recession or high volatility on the downside, more reversion to the mean of what things are actually worth. And the reverse is true. Just because something has been doing badly for a while doesn't mean that it will continue to do badly. And in fact, if it's been beaten down, it might be beaten down so much that the price that you're paying for it now is a bargain, a sale price. And if you think that the intrinsic worth is more, you can scoop it up at the sale price, have the courage of your convictions, hold it, and let it rise over time as eventually the market figures out, the general populace figures out what it's really worth, and then take your profits. So that's a great question.
Thank you both for answering that question so well. Certainly nothing I can add, other than to say certainly risk management is always top of mind for us at Altfest when managing investments, and certainly something that something such as concentration in a particular asset class in a portfolio, especially one that has outperformed tremendously in recent years, will generally give us pause and likely advise for further diversification if you're planning for a long-term time horizon. So thank you both again. Once again, just want to thank everyone for attending. We've hit 6 o'clock right now, so I think we're going to wrap things up. Once again, my contact information is listed on this page, and I encourage you to reach out to me anytime, especially to take advantage of that retirement readiness benefit. So thank you again all for attending, and have a great rest of the evening.
Thank you so much.